All right. So the objectives for chapter 2 is we're going to define and illustrate a cost object. We're going to distinguish between direct costs and indirect costs. We're going to explain variable costs and fixed costs. We're going to interpret unit costs cautiously. Design inventoriable cost period and inventoriable cost period cost, and illustrate the flow of inventoriable cost and period cost. We're also going to explain why products costs are computed in different ways for different purposes, and we're going to describe a framework for cost accounting and cost management. So some of the important terms that you're going to need for this particular class or this chapter is cost. Cost is a sacrifice or foregone resource to achieve a specific objective. So what we're talking about here, when we think of cost, normally what do we think of?
Thing that has a value to it.
Well, what do we use for cost? Money.
Yeah.
Money, okay? In most cases, that's what we're going to do. We're going to be talking about money, how much did it cost us? So cost is sacrifice or foregone resource to achieve a specific objective. The actual cost is a cost that has incurred versus a budgeted cost, which is a predicted cost. So a lot of times in management accounting, what we're dealing with is we're comparing budgeted to actual. So in the case of personal finance, at the beginning of the month, what are you supposed to do every single month?
Budget.
Do a budget, right? And so what are you doing? You're predicting your costs, for a particular month. So here comes February next week. So you write down everything that you have to spend, and you're predicting, I'm going to spend this much in food, I'm going to spend this much in groceries. And so that's what managers do. They predict using budgeted costs, to determine what is it going to cost to produce this table or this chair or this vehicle, okay? Now, in actual cost, so at the end of February, you take your actual cost, what you actually spent on everything, and compare it to your budget and see how you did. And that's what management accounting does. They take what they thought they were going to do and then what they did and do some comparison and find out where are they good, where are they bad, and what needs to be different, okay? And then cost object, anything for which a cost measurement is desired. So a cost object could be what you're producing. So it could be a vehicle. If you're Toyota, it could be a vehicle. If you're, say, Boeing, it could be an airplane, okay? So it's whatever you're producing. It could be this table. It could be this chair if you're manufacturing chairs or tables.
And
So
if you're doing services like law or accounting to someone.
Okay, so in an accounting setting, the cost object could be a tax return, okay, or an audit. So if I go and audit, Ivy Tech for some reason, if they have their books audited, my cost object would be Ivy Tech audit, and then all the costs associated with that would be directed towards that object, okay? All right, any questions on that? Okay. So examples, cost object examples at the BMW. So in this chapter, we're going to be talking a lot about a vehicle, BMW's vehicle. We have a cost object of a product. So in this case, it would be the BMW X6 Sports Activity Vehicle. Okay, so that would be their cost object. Another object would be their service. So telephone hotline providing information and assistance to BMW dealers. Okay? It could be a project, which could be the R&D project on DVD system enhancement in the BMW cars. It could be the customer. So in their case, because remember, when you're dealing with like BMW, they don't, who are their customers? Dealers. They're not the general public, so your car dealers, your car manufacturers, their customer is the dealers. It's never the general public like you and me. Okay? So in this case, their customer would be a cost object, which of course would be Herb Chambers Motors, a dealer that purchases a broad range of BMW vehicles. So their customer, each dealership would be a one cost object. Activity, in that case, it would be setting up machines for production or maintaining production equipment. And then department, it could be focusing on the environmental department or the health and safety department. So you can break these up, these cost objects up, just by what you want to concentrate on as a business.
Okay.
Okay? Any questions? All right, basic cost terminology. Still going. Cost accumulation is the collection of cost data in an organized way by means of an accounting system. Okay? So this is the actual, taking the information and putting it into an accounting system. You're collecting the data. Cost assignment is the general term that encompasses the gathering and accumulated cost of cost object in two ways. We have tracing and allocated. Now, tracing is dealing with a direct relationship. So on the BMW car, it would be the cost of the steering wheel. It would be cost of the tire. Anything that I can trace that I can physically put back onto that vehicle. The hours of the person who builds the car, the assembly line worker. Okay? Cost allocated is your indirect relationship to the cost object. So that would be the insurance on the building of the assembly plant or the utilities of the assembly plant. I can't tie this particular, watts of energy to this vehicle panel. Okay? So the indirect, the overall, where I can't tie it directly to a particular vehicle. So tracing, I would be able to tie it directly to a vehicle. This tire went on this truck, and then allocating would be, it's the big picture. It's the big thing like insurance and maintenance. It would be the managers of the assembly line. It would be, unless they're directly to one, department. It would be the insurance or property tax on the building, insurance on the building, electricity, things that I can't tie directly to a vehicle. So can everybody understand the difference? So allocating and tracing. Tracing, you can tie it directly to a vehicle, and allocating, you can't. It's something that's more big picture.
So do you just arbitrarily allocate?
We'll be talking about that later. Yeah. No, we don't arbitrarily allocate. We base it on different things. Okay? All right. Now, direct cost and indirect cost. We'll be talking about a lot this quarter or this semester. See, that's the problem with different schools on different, I either say quarter there or here and a semester there. So, but this semester you'll hear a lot about direct costs and indirect cost. Direct costs are costs that can be conveniently and economically traced to a cost object. All right? So, if in my garage door company that I work for, my cost object could be installation or repair. Okay? So installation direct cost would be the door that we installed. It would be the service van who went out to install. Those would be direct costs. The indirect costs cannot be conveniently or economically traced to a cost object. Instead of being traced, these costs are allocated to a cost object on a rational and systematic manner. So in the garage door company, me as the accountant could not be traced to Joe Smith's installation of his door. Okay? Because I cannot economically trace how long did it take me to process his invoice into our computer system. I couldn't do that. Okay? Not economically. That's the key. Economically. So you could probably break it down. I could write down, I started at this time and I ended at this time. But how much time does that take for me to write down every single invoice that I process? That wouldn't make sense. It would be a waste of time, right? And so what they would do is take the cost of my salary and spread it over all of the associated bills that I work on, if they wanted to get that detail. Okay? So remember, direct costs are costs that can be conveniently and economically traced. So that would be, the product that we installed, and the person who installed it would be the easiest people. And then the people, indirect costs would be those costs associated, with that install, but I can't economically spread the cost. Like the vehicle that the tech guy uses. We can't really determine the cost of that vehicle associated to that job. Okay? All right, any questions on that? All right. Cost assignment to a cost object. So in our BMW example, we have the direct cost and indirect cost. The direct cost would be the cost of steel and tires for the BMW X6. And then the indirect cost would be the lease cost for the Spartanburg plant where the BMW makes the X6 and other models of cars. Okay? So in the direct cost, I would take how much steel did it cost me to produce, or how much steel did I use for that particular vehicle, and what did that steel cost me? I would trace it to, I could physically trace it to this BMW over here. Okay? Same thing with the tires. I can physically trace those 4 tires, or 5 tires if you count the spare, to a particular vehicle. So I'm cost tracing those. And it's based on the material requisition document. We'll be talking about that later. Anybody know what the material requisition document will be? Take a guess.
Isn't that one division says, I need quantum X of product Y, bring it to me, and here's a formal request?
Yes. Okay. So the production manager lets the inventory manager know through a request, a documentation request, that I need this many tires or I need this much steel delivered to the production floor at this time. Okay? And then that request would go up to the accountant and they would put it in the system based on that. Okay? Now, the indirect cost, the lease for the plant, that's a cost allocation, and the accountant doesn't need any, documentation of that. So at the end, what we do is it could be based on production, it could be based on machine hours or what have you, floor space, either production or floor space probably. And that's how we would allocate the lease to the BMW, okay? And it goes all to the cost object. So, all right. So some examples in our BMW costs for direct costs. Of course, it's going to be the parts, the steel or tires for the car, the steering wheel or wheel, it could be the engine, it could be the seats, anything that is tied directly to that vehicle is a direct cost. Now, when we're talking about direct costs, we're going to break it up in two different types of direct costs, which is going to be your direct materials, which is the materials used to produce the product. And then it's going to be talking about the direct labor, which is the labor directly used to produce the product. And of course, that would be the assembly line wages. Okay? Now, so those are pretty well clear cut. The thing that kind of gets murky a little bit is your indirect costs. So your indirect cost could be the electricity for the plants, could be the rent for the plants, property taxes, and plant administration expense. Why do you think I can't tie that directly to a car?
If I've got a sales office up there someplace,
Uh-huh.
that's gotta be allowed for.
Mm-hmm.
So that's part of the plant administration. They're up there recruiting dealers and whatever.
Mm-hmm.
So they have expenses and that's something I want you.
What about a plant manager? Why couldn't I directly tie that to a vehicle?
Because he doesn't directly work with the company.
Yeah, exactly.
Yeah.
He does not directly work on that car. He is just someone who, is over all the cars. So he might not even just be over the one SUV. He could be over the car line or the truck line or something like that too. So, you can't tie it directly to a
The
vehicle.
accounting.
The accounting office. As I said earlier, it's hard to say, okay, this amount of counting can tie directly to this car. Because that would just get too tedious and it would not be a good use of time. Okay?
But you could do that.
Yeah, it would get very tedious. It's not cost effective. That's the one thing we also have to make sure it's cost effective.
So that's why you take the whole salary and say, okay, in that year, say like your yearly salary, in that year we do this many cars, so.
Yeah.
And now it's all separated into
Yes, exactly.
one shot. So
Yep, exactly. Mm-hmm. All right, factors affecting direct and indirect cost classifications. So some of them are the materiality of the cost in question, the available information gathering technology, and design of operations. A specific cost may be both a direct cost of one cost object and an indirect cost of another cost object. So materiality of the cost in question. Does it make a difference? That's the big thing. If and a lot of that would be like your nuts and bolts. Think about the little things. If I have a whole thing of nuts and bolts, like if you go to a hardware store and you go into line with the buckets of bales and things like that, they're not going to take the cost. They're going to spread the cost over time. It doesn't make sense for them to count every single nail, right? Because how do they sell those nails? They sell them by the pound, right? Okay. So materiality doesn't affect the issue. Okay. Availability of information gathering technology. So in our world now today, we're driven by computers. There are still companies out there that are not. So do they have the technology available for them to get down to the nitty-gritty? If you're talking Boeing, they might have it, or they might count the rivets in the airplane, okay? But if you're talking a mom and pop store that's building, little whatever,
Right.
you're not, it's not going to be that
Well,
cost
if you've got a
effective for
knitting
you.
shop, we're not gonna count it as dead.
Yeah, exactly. Okay, and design of operations. The more detailed the design, the better they're going to be able to keep track of things. Okay. All right, and again, a direct cost for one could be an indirect cost for another. So again, we take the example of the manager. If he is just a manager over, one particular line, that could be a direct cost. But if he's a manager over several lines, that would be an indirect cost. Okay. Any questions on that? Yes, no, maybe? All right. Now, We have direct cost, we have indirect cost. The other thing we have is what we call fixed or variable. Now, you can have direct costs that are fixed, you can have direct costs that are variable. You can have indirect costs that are fixed and indirect costs that are variable. Now, what is the difference? The variable costs are change in the total and production of proportion to changes in the related level of activity or volume of output produced. So basically, the cost determines the cost is determined by the number of items I produce. So a variable cost for a car would be what?
DVDs, maybe you don't put them in all the cars.
Yeah, okay. But it's driven by what? It's driven by the number of cars you put them in, right?
Yes.
Okay, so it varies.
Yeah.
Tires, the number of tires. Yes, a car has to have 4 tires before it can go anywhere, or 5 if it has a spare, right? That's variable. Why? Because it depends on the number of cars I produce. All right?
Yeah.
Now, the fixed costs remain unchanged in total for a given time period despite changes in the related level of activity or volume of output produced. So fixed costs are basically those costs that no matter how much I produce, I still have the same cost.
You gotta break every year.
Huh?
Every month. You have a
Yeah.
nut you gotta break every month or year.
Yeah. So your fixed cost would be your rent on your building.
Yeah, utilities.
Utilities. Now, some people might argue that could be variable.
Yeah.
Why?
Because you can have a night shift.
Yeah, it changes.
Everything turned on.
Exactly. But your fixed costs are those costs that do not change based on production. So it would be your rent, it would be your property taxes, it would be your insurance on the vehicle, it would be salaried employees.
Yeah.
Those are fixed costs. Now, variable costs for employees, which ones are those? Those are your hourly people, right? They would be considered variable because number of hours determines how much you pay. Okay? Costs are fixed or variable only with respect to a specific activity or a given time period. We'll be talking about that more later on, okay? Any questions so far? Now, variable costs are constant in a per unit basis. If a product takes 5 pounds materials each, it stays the same per unit regardless if 1, 10, or 1,000 units are produced. So variable cost, it's going to cost me $50 per tire, no matter what. So the cost per unit stays the same, but the total cost varies. Okay? So if I say $50 for a tire, and I need 100 tires, my cost would be $5,000. If I need 1,000, then it would be $50,000. So in variable cost, the fixed cost portion of it is the cost per unit. The total cost is what is different. Now, in variable cost, in fixed, that's variable cost. Fixed cost per unit change inversely with the level of production. So basically what fixed cost means is that the cost per unit goes down the more you produce. Huh? Like a salary. So if I have rent of, say, $5,000 per month, and I produced 50 vehicles, well, that's $100 per vehicle, right? But if I have rent of 5,000 and I produce 500 vehicles, then it's $10 a vehicle. Okay? So in variable cost, the cost per unit stays the same, the total cost goes up. In fixed costs, the cost per unit changes while the total cost stays the same. Does everybody understand that? Okay. So this is a really nice picture. I don't know if you guys are more of a picture type people, than, explanation. So we have variable costs and total dollars. Variable changes in proportion with the output. So that means more output equals more costs. And the cost per unit does not change, no matter what, unless you have one of those sliding scales, but we'll talk about that later. All right, and then fixed costs, your total dollars are unchanged with relation to the output, but the change inversely with the output, meaning basically the more you produce, the smaller the cost per unit is going to be. Okay? Any questions on that?
Hold on a second.
Okay. So if you want to see it graphically, we have on the left dealing with the variable cost of steering wheels. You got to have a steering wheel inside a car,
Yeah.
right? All right. So basically what they're telling us that each steering wheel is $60 per vehicle or per, steering wheel. So the line is always going to be going up from left to right. The more we assemble, the more cost is going to involve. Now, on a supervision cost of the BMW, so in this case, total supervision dollars is $2 per vehicle, or $2 total. That doesn't make sense, but then it doesn't change based on the number of vehicles. You're still going to have that one supervisor. Okay? So the fixed cost is a straight line vertical, and then horizontal, and on the map region. And then we have an upward sloping line for the variable costs. Now, what is the cost driver? Cost driver are variables such as the level of activity or volume that casually affects cost or a given time span. So we'll be talking more about cost drivers here in a few minutes, but it's the variables such as the level of activity or volume that casually affects cost over a given time span. Because what happens with cost? The more you produce, the less it's going to cost, right? In most cases, because what happens? You get better at it, gets faster, things like that.
Yeah,
okay?
the economy scale.
Cost, yeah. A cost driver also is talking about what drives the cost. So the number of vehicles produced would be a cost driver of the truck. Okay, it could be machine hours, it could be labor hours. Those are cost drivers. Relevant range, the band or range of normal activity in which there is specific relationship between the level of activity and the cost in question. For example, fixed costs are considered fixed only within the relevant range. So I'm not sure, let's see, do they talk about here in this? All right. So in your book, what they talk about, I believe, is a truck. So with this truck, basically what they talk about in this example in the truck, what they use is the truck can go 120,000 miles. All right. So if you have two vehicles, what would be the relevant range of those two vehicles? Huh? Yeah, between 120 of one vehicle and 240 of the, with the combination of the both vehicles. So the relevant range would be between 120 of just one vehicle and 240, which is the combination of both vehicles. So anything over 120, that means that you have too many trucks. If you don't go 120,000 miles, you have too many trucks if you have two trucks, okay? If you go over 240 miles, guess what? You don't have enough trucks. But if you go anywhere between 120 and 240, then you have enough trucks to cover your requirements. Does everybody understand that? So one truck, you have two trucks, 120, 240. And in this one, you have too many trucks. If you're anywhere below 120,000 miles, and if you're over 240,000 miles, you have not enough trucks. Okay? So the relevant range is, more than one, but less than two. Does everybody understand that?
Tell me the less than one again.
It's on page 35 in your book, too. But basically, if you have two trucks and they both can go 120, so that's a total of 240.
Yep.
If you go less than 120,000 miles,
I got too many trucks.
you got too many trucks because you reality only needed one truck.
I got you.
Okay?
If I'm over 240, I need another truck.
Yeah. You don't have enough capacity to do all the work that you could do.
I agree.
Okay? So the relevant range is more than just one truck, but less than two trucks. Okay? Now, cost may be classified as either direct or indirect, and then variable versus fixed. We're on page 36. Okay? So, when you're dealing with costs, you're going to have two classifications for each cost. You're going to say there are either direct or indirect. They can't be both. They have to be either direct or indirect. And then you classify, are they variable or fixed? So variable, I pay only the amount I need, right? Fixed, I have to pay no matter what. Okay? Direct, I can associate it directly to the product I'm producing. Indirect is more of the big picture. Okay? These multiple classifications give rise to important cost combinations. So you could have direct and variable. So what would be an example of direct and variable? A direct cost would be something I can tie it. Let's concentrate on the car. Yeah, the tires. Okay, it's direct because I can tie it directly to the truck, right? And it's variable because what? It's based on the number of vehicles I produce. What about direct and fixed?
Tires have a fixed cost.
The tires are always going to be direct and variable. Yeah, if it's specifically for that particular line, then it could be the supervisor for that particular line. Because it's direct, because he's only over that line, but it's fixed because no matter how many cars he produces, he still gets paid that particular line.
So could I get the workers on that line too?
Only if they're salary workers. That's a good question. If they're assembly line workers, you can tie it directly to a vehicle, right? But only if it is a salary worker, if they have a fixed cost. Because most assembly line workers, what are they paid? They're paid hourly, right? But if it's a fixed cost, if it's a salary, then it would be a fixed cost, okay? Because no matter what, I have to pay him $40,000, whether I produce 40,000 cars or 10,000 cars, okay? All right, indirect and variable. What could that be?
Electric, yeah.
It could be electric, okay? Yeah, because electric does vary. Some people will say that, well, that's a fixed cost, but you could say it's a variable cost.
If you
Okay.
got no net shift.
What about indirect and fixed?
You gotta pay the guard whether or not anything. So
It could be the guard, it could be who else? Plant manager, okay? It could be the accountant, right?
Yeah,
If indirect and fixed could be insurance on the building. The rent is a big one because usually that is definitely fixed every single month, right? All right, so things that is the overall, the big picture. Things that are directly to that vehicle, indirect is the big picture. Okay? All right, a cost caveat. Unit cost should be used cautiously because unit costs change with a different level of output or volume. It may be more prudent to base decisions on total cost basis. Unit costs that include fixed costs should always reference a given level of output or activity. So we're talking about fixed costs of possibly, say, electricity. Let's just say that is a fixed cost. Now, it would be based on a given level of activity, would be if we have to shut down the plant, or they don't do overnights, that changes. Or production slows down, or production speeds up, you probably have to use more energy, right? So the unit costs are also called average cost. Why is it average cost? Unit cost or average cost? Or could be called average cost.
The average cost.
Yeah, because think of it this way, what about gas? Think about gas, your vehicle gas.
yeah,
What happens every day with the price of oil?
that varies.
It goes up and down, doesn't it?
Yeah.
Okay, so,
Because it went up 36 cents today.
Yeah,
it did?
yeah.
Yeah.
Really?
I got it for $1.46 yesterday. It's $1.79.
If you can find it for $1.50 or less tonight,
Fill it up.
anywhere,
7 cents,
get it.
where at?
North Anderson, when I came through,
Well, because you
North
have,
Anderson was still down.
yeah,
I'll have to go check that out. But yeah, so they
Yeah, let's
have to, when you're dealing with the car or the gas stations, we're dealing with variable costs or average costs. We're dealing with average costs like with the price of their gas. Because what happens, they can't say, I always argue this, I'm like, how can you charge me $1.47 today and $1.79 tomorrow when you didn't get
That's
a truck full of gas?
I know.
Yeah,
But it all goes back to their cost. They have to average it because yes, the gas that's currently in the tanks now might have cost them $1, but the gas they're going to get tomorrow is going to cost them $1.50.
but we were actually 50 cents under the average cost per gallon for the United States.
Uh-huh.
'Cause
There's places in
well, I don't know, I
Michigan
mean,
that
the
was less than
rent's
$1.
supposed to be kicking up fuel, so.
Well, it's only like $30 a barrel right now. It should be under $1.50.
Yeah, but the whole thing is,
Yeah.
they average cost their cost of the gas, okay? Because they can't say this particular gallon costs me this particular gallon is that. So that's why unit cost could be average cost. Managers should think in terms of total cost rather than unit cost for many decisions. Because we're not concentrating on just one vehicle, right? We're concentrating on 10,000 vehicles. So yeah, my cost per unit for that tire might be $50, but I can't concentrate on just the $50. I gotta concentrate on the $50,000 it's gonna cost me, or $500,000 it's gonna cost me for all those tires, for 10,000 units, okay? So think of that, okay? So managers need to look at the big picture and not just the cost per unit. You still gotta look at the cost per unit, but you have to more concentrate on the big picture. So examples of the multiple cost classifications. Okay, so variable cost and direct cost. So for variable cost and direct cost, the object is going to be the BMW 6X6 produced. How many are produced? Examples of the direct costs that are variable costs are tires used in assembly of the automobile. So each vehicle gets 5 tires. Now, for direct costs, fixed costs, same cost object, the salary of the supervisor on the assembly line that we talked about earlier. Has to be only for that assembly line, only for the X6. The indirect cost, which is a variable cost, the power cost of the plant, power usage is needed only to the plant where multiple products are assembled. So it's an indirect cost, but it's variable based on, the production lines and how much they use. And then the indirect costs that are fixed costs, the annual lease cost of the plant. The lease is for the whole plant, whereas multiple products are produced. So their cost object would be how much floor space that the X6 takes up. That would probably what they'd be using to divide up the fixed cost there. Okay. All right. Any questions on those? Yes, no, maybe. All right, that's going to be a good place to stop. So we're going to take a break. Be back at about 5:10 after, and then we'll go on from there.